Welcome to our weekly market review brought to you by ETM Analytics and Treasury One. I'm joined by Andre Celia, currency strategist at Treasury One. Looking for the data that came out quite late on Friday. It was the PMI index from the US, which came out again stronger than the rest of the PMIs that came out, I think, from the UK and Europe and elsewhere. And it just shows this American economy is going nowhere. It's remaining resilient despite all the tight monetary landscape that we're seeing. And with the PMI and everything else that's remaining robust, we're also seeing it being reflected in the recent jobs data. Jobs, I think it's a record streak by now, Andre, of jobs created in the US economy.
Yes, good morning to everybody. I think if we would speak about jobs, the 1 week or the 1 month we get non-farm payrolls, it's above the level, and then the next week it's below the level. US unemployment has now crossed its 36-month moving average, or busy crossing it for the first time in 4 years. They've added jobs for 41 consecutive months. Record number of that, but we've spoken about that before, is part-time jobs. I've mentioned that it is Northern Hemisphere. It is July, August, coming into the peak holiday season, so few temporary jobs is quite possible. But then you mentioned the PMI, and it's all saying to us, guys, you're clutching at straws. We're doing okay. We're not really going anywhere, but everybody out there, including the Andre Celias and Ilse Maries, is clutching at straws to try and find something that's wrong in the American economy. And we've told you, we'll watch the inflation rate. We want our inflation closer to our 2% target, and then we will look at interest rates. And some of the federal people comes out now and says it might take up to 2 years to reach that 2%. In the meantime, the economy is plodding along quite happily, some days up, some days down, but it's okay. People are surviving. They're not in the doldrums. So I think instead of clutching at straws, we should just pay attention to what Mr. Powell's telling us. I'm watching inflation. And as long as my inflation is above and way above the target, we must remember, if we speak about 1% above the target levels of 2%, it sounds very little. But 1% with a 2% target rate is 50% above the target rate. That's substantial. And if we had looked at the inflation figures that came out for the last couple of months, yes, it's certainly been pointing a little bit downwards, but the month-on-month figures multiplied by 12 still gives you way in excess of 2%. So for the next couple of months, if we don't see figures that's very flat or even slightly disinflationary, they're not very fast on their way to reaching their target. So that's the American economy, that's the Fed, and they're going to be stubborn. They want inflation down. So let's give them time and let's watch the inflation figures. In the meantime, we'll keep clutching at straws. We'll keep looking at what happens in the economy to see whether there is something that comes up that tells us that inflation is definitely turning.
Yeah.
But the one thing that we must remember, and we've spoken about this extensively before, there's still wars going. There's still a lot of arms needed. It's built in America. It's sent to the war zones. As long as that's happening, chances that we're going to find something substantial in unemployment or jobless claims or non-farm payrolls is rather slim. So let's really keep on, as I say, clutching at these little straws of ours and see what we can find in the American economy that gives us more information. But as long as it doesn't firmly point to lower inflation, interest rates will remain high. The dollar will remain on the front foot,
Yes.
and it will remain at stronger levels.
Definitely. So with the strong jobs data, I know there's a revision of Q1 GDP US data also coming out. We're not really expecting that it will be lower, might even be revised slightly upwards. So the US economy definitely holding up for various reasons. Maybe US exceptionalism is just going further than we expected. But all of this is obviously, like you're saying, giving grounds to the US Treasury, the Federal Reserve, not US Treasury, the Federal Reserve, to stick to their narrative of higher for longer. And if it takes longer, the rest of the currencies and markets are going to definitely feel the pain. But we saw with the strong PMI, we saw with the strong jobs data that it is keeping the dollar on the front foot.
Indeed. I think the one that we really should also look at is this little graph that's everybody can see now, is the fantastic currency called yen. Well, certainly if you were buying Toyotas in South Africa, you'd be very happy because you're not in for massive price increases because it comes from Japan, and it works in our favor. I mean, in South Africa now, we are trading against the yen, and Vichar and myself spoke about it the other day, that we're now trading at levels where we had last seen the yen trading against the rand, or the rand trading against the yen, around these levels in 2018, 2019. So for the last 4 or 5 years, we're on par with what we were 5 years back. So yen extremely weak. Their monetary policy not changing at all. They're not increasing interest rates, which is something that the market is waiting for. And as long as the market is not getting what they're waiting for, then they trade against it, which we are definitely currently seeing. But we're getting closer to levels where we might see the Central Bank of Japan actually coming in to try and support their currency through intervention. Now, intervention is an interesting one. We've seen these things many, many times before. It's got a short-term effect. The only thing that really changes the trajectory of a currency or on a longer term basis is fundamental changes, and these fundamental changes that looked for is interest rate changes, which is not happening. But look around the 161, 162 levels, most probably to see some support from the central bank coming out in terms of intervention.
And we saw this when they started to pivot from the negative interest rate earlier this year. I think they changed their monetary policy to move out of negative interest rate territory, and the yen just spiraled. And then the central bank definitely stepped in again. They are becoming more cautious of such measures, I think, the Bank of Japan, as they're trying to almost normalize the interest rate and the currency a bit more and get it aligned to what the market really wants. But there are some risks involved. In fact, we actually did an entire series on it on our YouTube channel, Markets Magnified, with ETM Analytics, about why Japan's negative interest rate failed. It's a very interesting story. It's one of those economic stories that it's difficult to believe that is happening. Any case, we spoke about the rand, Andre. We spoke the yen. We spoke about the dollar, the rand. How are we doing? Is it still hanging on to a thread? Looking for direction from the GNU, perhaps before making a move.
Yeah, before I step onto the rand, last comment about Japan, and that's a sneaky comment. It's always difficult to manage an old age home. When you're speaking about the elderly in old age homes, it's difficult to manage it. So the central bank's got a job cut out there in Japan. When we look at the rand, then we have to speak about something called a GNU. And that's not the wild wilderness up in the bushveld, but it's the government of national unity. Unity, emphasis there on the unity. I currently don't see that much unity. We need a cabinet. We need an opening of parliament. We need actually these guys to start working. We are way into June after the elections, and we're not seeing anything. And we've had the provincial government or cabinet for the Gauteng area being postponed yesterday, and it's all about who gets what, who's in charge and who's not in charge, and who's got insights and who's not got insights. And there seems to be a fight between these parties and not reaching consensus. So I think we have another couple of days to see what happens. In the meantime, that plays out on the rand. We are seeing it a little bit weaker this morning, around the 1810 levels, but it's still stronger. It's still below the 1820 bottom of the band that we've seen for so long. And I think it will remain. I think they will reach consensus. How long the consensus will be there for becomes debatable. I think I have mentioned that this is not the most stable form of government. And we will have these teething problems for quite some time, and it will stay with us for quite some time. But I think they will reach consensus. We'll just see how much of a consensus is reached and how well it works.
Yes.
But for the moment, the rand slightly weaker, as I say, still below the band. I still think that we can start drawing new lines, the lines that I would put in for a band of the rand would be 1850, 1750 for quite a period of time, that it will hold within those levels. And obviously the emphasis will be on how well the GNU works. Breaking out of the 1850 if it falls over and gets disassembled, and reaches the 1750 area as things go better. But I do not think that we're in for a 1650 or a 17 or something, because any changes will happen slowly, and it will take some time to work through. It will take some time to have an impact on investment into the country. So I think we can pencil in those lines, 1750, 1850.
Yes. Look, I don't think Ramaphosa has much more scope than this week to push out any cabinet announcements. So I'm hoping that we will see some movement from that side. But the longer he takes, the more parties are being included in the GNU, which makes finding common ground that much more difficult. And I think that's what's making markets a little bit wary of how this is going to proceed. But it is politics. It's South Africa. I'm sure by Monday next week, we'll have a completely different narrative to dissect. Andre, thank you very much. Stay warm, and we will catch you again next week.
Thank you very much.